YouTube, what's going on? Jay Athens back again with another video. Back again. I told you I was coming to drop the sauce on you guys. So here we go. Now, today's video, we're going to talk about margin management in Forex, or if you want to call it risk management in Forex. Now, I got my handy tool, got my calculator, because we're gonna prove a point right here. Now, here's the narrative. Here's the narrative in the Forex market. All new traders will hear this. Oh, you got to work on your psychology, how you live your life, how you eat, all of that to take a trade, to make some money. Now, that's one part of it. And then they'll say, okay, don't risk no more than 2% per trade. Tell me what trader you've seen online that haven't said that. I'll wait. They all say it. Because why? Everyone has the same narrative. And I'm sorry to burst a couple bubbles, but that narrative is, in my opinion, let me throw that disclaimer out again because I don't want nobody crying in the comments. In my opinion, that's a gambling narrative. You're telling a person to take 2% per trade. Now, let's just say that person has $500. And you know the narrative. Have a proper risk management. You got to have good psychology. You got to, do the whole nine. Now, if they have $500 in their account because they're a new trader, they don't have much, but they want to make some money in the markets. Now, $500 times 2% equals $10. Now, why is this narrative going around in the retail Forex market? And why is everybody pushing something that doesn't really make sense? Because $500, 2%, $10. Now you're telling me in a trade, don't risk more than $10 per trade. Now let's look at my screen right here. And we see right here, we have margin per 0.01 lot size. So if I look at Aussie CAD and I just take one position, you notice the cost of that is going to cost me $20.63. So it cost me $20 to get into the trade. So in all actuality, are you telling them to risk when you get into the position? When it goes down $10 from your stop loss, that is where your stop loss is going to be? Or are you telling them don't risk more than 2% per trade? Because if that's the case, they can't even get into a 0.01 because it costs $20 to get in. So when you say that, if that's the narrative that most people are pushing on social media, it should be 4% per trade. So let me give you how I approach the market and the method I use to build a portfolio. So as you see on your screen, it says right here, $20 pip value, 8 cents per pip. Now, let's leave it at 10,000 and let's change the margin. Let's put it at 30% margin. Now, this is how I'm going to use my account size to open a portfolio of positions. Because why? I want each position to pay me an interest spread for holding the trade. Yes, guys, your broker can pay you an interest spread for holding the trade. Even if you are in a losing position in the direction, you will still get paid an interest spread. Want to learn this concept? Come over on May 10th to the macroeconomics training program. And I will teach you how to approach the market in this sense. So let's go back to this example. Account size, $10,000. Now, I want to look to open a portfolio of positions, multiple positions. So this is all dependent on each person. I like to use 30% of that 10,000. So what's my limit? $3,000. Now, doesn't that sound better to a person to when you tell them, okay, go into the market with a certain amount of percentage margin and you work with that. So what I'm doing is I'm taking $3,000 of my initial margin and what I'm doing, I'm sticking that into the market. And What I'm doing with the 3,000, I'm taking long, short positions. Majority of them interest rate spread pairs. So I'm earning an interest for holding that position. So if I go out of $3,000 limit, then I know I'm losing money because I have $7,000 in margin left out of that 3,000. So when you decide to say, okay, I'm going to take a certain amount of margin, a percentage, and I'm going to work with that, because the concept that I teach on interest rate spread pairs, you would realize, well, this type of risk management fits perfectly for it, because you can then open multiple positions, and then each position is giving you an interest spread or a payout. So you know what I mean? What I mean by this is the swap payout. Have you guys ever experienced in the market where you took a trade and you might be winning, you might be losing, but then when you look at that swap, it's negative? Well, guys, you can turn that to a positive. You can literally get paid to hold positions. This is why I hold positions so long, because most of my trades are interest spread pairs. You know, EM markets, Mexico, ZAR, they pay heavy amounts of big amounts of interest spread on that. So when we look at that margin, right? 30%, we're using 3,000, we're open multiple positions. And all of those positions needs to pay us an interest spread. This is some form of day trading without actually opening and closing positions, because at the end of, after 5:30 every day, the broker is going to pay you a positive swap. Now, I literally had one of my members tell me, he said, man, he said, Jay, I don't understand what the hell just happened. He says, I took a trade. I was down $300 on the initial position. But when he looked at his profit, he was up $400. I said, welcome to the world of interest spreads. What you literally did was, you weren't a trader. You were an investor into the market. So you took that $300 loss, right? As far as direction, someone had to obviously win that. So as you lent your money out, the broker knows you're smart. You got that money back, $400. That's $300 back and $100 in return, because you're on the right side of interest spread. This is why I recommend people understand the fundamentals behind currencies, volatility, everything behind that, because with that knowledge and that understanding, you can have a better risk management in the market. So like this title says, margin management in Forex. Guys, some people don't have the same amount of account. Some people have 5,000, some people have 500. And we just saw $500 is only $10. And it cost me $20 to get an Aussie CAD on a 0.01. So how are you looking at it? Are you saying $10, then we're out? Or the cost to get into a trade? If not, take the approach that I'm showing you. You can have better management over the amount of money you're pushing into the market and how much you're making back. This is the real way to approach currencies, guys. A lot of people will say, well, I want to trade Aussie CAD, because you picked a pair. That's not what it is. I have my partner and he said to me this morning, and I like what he said. He said, man, I was looking at the pound trade, but it costs too much. So you see how his language is. It's not about because he wanted to trade the pound. He just said, well, based on his margin size, the pound is going to cost him too much money to get into. That's management, guys. That's real risk management. So if you found some value in this video, go ahead and give it a thumbs up. Drop your feedback in the comments. And until next time, guys, I will see you next time. Later. Take care.